I just completed a deep dive into Intel, ticker symbol INTC. So the majority of today's video is going to be my assessment of Intel Corporation. Also, I just started a new Dividend Snowball portfolio, and I've selected 3 stocks for that portfolio. I will share those with you at the end of this video. So if you're interested in Intel and what stocks I've selected for my Dividend Snowball portfolio, stay tuned. Hey guys, Kevin Burgess back yet again with another video. Today we're going to talk about Intel. Now Intel is an integrated chip, not only designer but also manufacturer, which makes it a little more difficult to analyze. Once I got into the analysis, I realized I didn't understand the whole chip industry. So I spent some time diving into the whole process around chips. But specifically, I want to share with you about Intel and whether I consider it something worthy of investing in for my portfolio. So let's take a quick look at Intel's past performance. You can see that over, let's say, a 1-month period, they have lost about 3.45% in market value. Over the last 6 months, they're down 32%. And on a year-to-date perspective, they're down 30%. Over the last year, they're down 34, almost 35%. So they've taken a real beating over the last year. And so the question is that warranted, or have they really been beat down too far? And is it time for us to invest? So in other words, is Intel a deep value play? And then also last week, I started a new Dividend Snowball portfolio. Now this Dividend Snowball portfolio is going to be invested in stocks that I expect to grow a lot over the long term. So if you are just starting out in dividend stock investing, I think this portfolio probably will speak to you more than my income portfolio or the dividend growth portfolio. But hopefully all 3 of them have some value to you as you're looking at what stocks to buy. So if you're into dividend stock investing and you like videos like this that talk about individual stocks as well as portfolios, smash that like button. I would appreciate it. It would help the channel out a lot. And also it tells people that what's inside this video may be worthwhile to watch. So I would appreciate it if you would do that. And if you like these kinds of videos moving forward, consider subscribing to the channel. I'd love to have you along for the journey. And with that, let's get started. Now, Intel was incorporated around 1968. And believe it or not, the chips that they manufacture are made from, you guessed it, sand. They take sand, and through a process, they extract the silicone from that sand, and they make wafers. And those wafers then can be designed into chips. So this may be embarrassing, but I never knew why they called it Silicon Valley. And now I do. They take silicon out of this sand and they make wafers out of it. So therefore, Silicon Valley. So let's take a look at what Simply Safe Dividends says about Intel. They have them a dividend safety rating of 80 with a dividend yield around 3.9%. I wouldn't consider this a high yielding dividend, but it's getting pretty close. I consider high yield around 4% or greater. They've got a dividend growth this past year of 5%. I will show you this. Historically, they have been in the 90s from a Simply Safe Dividend perspective. They were, in March of 2019, they were a 92. In October of 20, they went to a 96. But yet in February of 22, that would have been about 4 months ago, they were downgraded to an 80. And it has to do with their strategy. We'll talk a little bit about that as we move forward. Let's look at some of the metrics here. They've got a payout ratio of 28%. Now that's really good until you look at the forward payout ratio of being 42%. That again is a result of their strategy, which we'll talk about a little bit later. Their last 5-year dividend growth rate has been around 6%. I don't expect that to carry forward, especially over the next couple of years. I could be wrong, but I think they will grow the dividend, but it will be at a slower pace because they are diverting their capital from their dividend program or repurchase program and investing in facilities and equipment. They've got a dividend growth streak of 7 years with an uninterrupted dividend streak of 23 years. So they've paid dividends for the last 23 years and have grown it for 7 years. So let's look at some of the financials here. We talked about the earnings payout ratio. It was at 28%, and it over the next 12 months is expected to be around 42%. Their free cash flow is jumping up. It already has jumped up to 58%. We really want that to be below 50%. But again, their strategy is to invest heavily into not only the chip design process, but also the manufacturing process. Their earnings per share is on the downtrend. Their free cash flow per share also is struggling. You can see that their shares outstanding have come down. They've bought back about 1 billion shares over the last 10 years, but that has been halted as they invest in the future of their business. You can see that the sales have kind of flattened out and are expected over the next 12 months not to be what they have been in the past. So the return on invested capital reached a peak in 2018 at 23% and is now down around 14%. Now this 14% will likely get worse until they can actually begin to get some return from that equipment. Their net debt to capital is actually 0. They actually have more cash than they have debt. They do have debt, but they have more cash than debt. And their interest coverage ratio is 36. So they're well equipped to cover their debt levels. The way I look at the chip business is I kind of separate it into 4 different categories, or 4 different parts of a process. The first part is the instruction set architecture. And some people know this as the x86, so 286, 386, 486. Intel has quite a bit of intellectual property around this instruction set architecture, and it is the design by which chips are made. The second piece of the process is chip design, and this is probably one of the most competitive parts of the process. There are competitors in the chip design process: Qualcomm, Nvidia, Samsung, AMD, and now Apple has begun to get into that realm as well. So there are a lot of chip designers in that market. The third piece of the process, at least the way I look at it, is fabrication. So there are 3 major aspects to fabrication, in my opinion. One is the facilities. The facilities have to be totally clean. There are these clean rooms. Even one particle of dust could ruin an entire wafer, which could be 10,000 chips. So therefore, it's important that the facilities have the ability to have these state-of-the-art air handling systems. The second piece is equipment. It takes tremendous capital to buy the equipment necessary to make these tiny chips. And what I've learned is that some of these chips have strands in them that are 10,000 times smaller than the human hair. So these are really, really tiny chips. Inside the fabrication area is not only the facilities and equipment, but also the expertise to get that done. And then the last part of the process is packaging. That's where they put, connectors on, protection on them, and packages them up, test them as well, and then send them out. So Intel's strategy is they want to compete in all of those areas. And that makes them a little different than, not a little different, a lot different than most others. If you think about Qualcomm, Nvidia, AMD, Apple, all of those designers are what they call fabless. That means they don't have the capability to manufacture the chips. So they outsource their fabrication to a third-party fabricator. And the biggest one in the industry is called TSMC, which is Taiwan Semiconductor Manufacturing Corporation. And so a lot of competitors to Intel are using TSMC as their fabricator of choice. So much so that TSMC has over 50% of the market in fabrication. They are a huge player. So what does this mean? It means that Intel is investing tons of money into a strategy that's going to compete across all of these areas. So they are investing in chip design, they're investing in fabrication, and they're investing in packaging. So the question for us is, can they compete in all of those areas? And that's a difficult question to answer, but we're going to take a shot at it. So now we're going to take a look at their 10Q, which was just issued back in April. It's also important to look at some of the key developments. They've announced plans to invest up to 80 billion euros over the next 10 years. And again, here they say across the semiconductor value chain, that is all of those areas that we talked about, from chip design to fabrication to packaging. And actually they say it a little differently here. They say from R&D to manufacturing to state-of-the-art packaging technologies. They plan to invest an initial 17 billion euros in a fab site in Germany. So you can see here their operating segments. They have a client computing segment, a data center and AI segment, a network and edge segment. Then they have accelerated computing systems and graphics, Mobileye, and Intel Foundry Services. So these first probably 5 areas are in the chip design area, and then we have the foundry services, which is the foundry piece of that. So now let's spend a few minutes in the management discussion and analysis section, the MD&A section. I think this is really important to point out. You'll see that in Q1 of 2022 in the client computing group, or what they call CCG, their operating income was $2.8 billion, but the same quarter in 2021 was $4.3 billion. So they've lost some of their operating income out of this client computing group. Now let's move on then to the data center and AI group. You can see that their sales are up a lot in this area, about 20%, yet their earnings, their operating income is flat. So it took more revenue this year to make the same amount of money as it did last year. On network and edge, you see that this is actually pretty small in terms of their business. They went from 1.8 to 2.2, so pretty decent increase there. And then they doubled their operating income, but it went from 0.2 to 0.4. So it's a pretty small piece of their business. Computer systems and graphics, they had roughly the same amount of revenues, but they went from a $2.2 billion loss to a $0.4 billion loss. Mobileye, again, very small, $400 million in revenues both years, and went from $0.2 billion in operating income to $0.1 billion. So basically in half. Then we come to Intel Foundry Services. They had $100 million of revenue in 2021, the first quarter of 2021. They now have, in the first quarter of 2022, $300 million of revenues. But as you can see, they have no earnings, so it's pretty flat. And then also, this is important, the gross margin for the company has gone from 55.2% down to 50.4%. Pretty significant drop in their gross margins. And one other thing to point out in their 10Q is that the cash used from financing activities was lower in the first 3 months of 2022, and mainly due to our shift away from repurchases of common stock. So they are no longer going to be repurchasing common stock. They're going to be investing in their business, investing in equipment and facilities to be able to carry out their strategy. What is important is, where do we see Intel? And so what I'd like to do is walk through the 5 steps that I use to assess companies that I invest in. So let's take a look at Intel. Okay, so when we look at area number 1, we look for financial assessment. So how are they doing financially? They have a payout ratio in the mid 20% range, but it's rising to 42%. Their return on invested capital is between, let's say, 23%, and it is now recently in the 14% range. They're investing a lot of money in their business, and it's impacting their return on invested capital. Their net debt is 0, so that's a good thing, and their interest coverage ratio is around 36. So from a financial perspective, they're doing okay. So now let's look at the capital allocation assessment. The share repurchases have been halted, but their dividend is reaffirmed, and there's significant investment in their business capabilities. Well, I do have that as a yellow because I'm not sure that their strategy is focused enough They want to compete in every area. Sometimes it's difficult to focus attention when you're trying to do everything. And so that concerns me a bit about Intel. In terms of valuation, let's take a look at what Morningstar says. They have a fair value of $65 for this stock. It closed at around $37.21. So it is about a 43% discount according to Morningstar. So that's obviously a pretty good valuation. It makes this decision a little more difficult because if it was at fair value, it would be a clear decision for me. And then when we look at the company strategy, I think they have a good strategy. They have a pretty complete strategy. They plan to compete in all phases of the value chain, and the competition is significant in both chip design and chip fabrication. So if they're going to compete in those realms, they're going to have to bring it, and they are definitely bringing the capital to the party. The last segment here is in company management assessment. I put that as a yellow. First of all, Pat Gallagher as the CEO, I think, has laid out a really good vision, and he's got a lot of good energy around Intel's strategy. The challenge for me for their assessment is that they have not done a very good job of staying with their strategy and actually achieving the goals that they have set out for themselves. So they are delayed in their 7-nanometer chips, and TSMC is beating them in terms of foundry building here in the United States. So I'm not convinced that Intel has the ability to compete better than their competitors. So I'm not convinced that Intel has the capability of excelling beyond their competitors in these areas, because everyone is growing. TMC is investing tons of money, Samsung's investing tons of money. So it's a race to get to these fabrication capabilities. So I'm not really sure at this point whether Intel has the ability to grow that business and to carry out that strategy in the way that they see the strategy unfolding. So for me, where does that put Intel? I'm going to wait. I know they're at a really nice discount now. So if you're investing in Intel, you're getting a really good discount on a company that has been around for a long time and has been run very well for a long time. I'm just not convinced that they have the ability to carry out their strategy. It is huge, and it requires a lot of capital and also expertise. So I think they're going to struggle with their strategy. So I'm going to give them some time. I'm going to see what they invest in. I'm going to see how well they carry out their strategy before I actually decide to invest money in them. So now let me give you the update on the Dividend Snowball portfolio. Just to refresh your memory, my approach was to put the initial investment of 80% into the ETF called SCHD, the Schwab US Dividend Equity ETF. And then 20% was to go into individual dividend growth stocks. The reason I did this is because SCHD gives me some really good diversification, and it has a pretty decent yield. And then also, by putting 20% in individual growth stocks, I get the ability to learn about companies and learn how to invest without really investing a lot of my money into stocks early on. So, which stocks did I decide on? I decided on actually 3 stocks. I was going for 2 to 3. I invested in 3. One is Microsoft. I'm putting 40% of the money that I put in every week into Microsoft. I'm putting 40% into Google, and I'm putting 20% into Starbucks. So these 3 stocks I think are going to do well in the future. And so therefore I'm putting them into this Dividend Snowball portfolio. So that pretty much wraps it up for this video. If there's another company that you want to see me do some deep dive into, let me know in the comments below. I'd love to hear from you on that. So we're about to enter earnings season, and that should be kind of interesting. I'm expecting some of the stocks not to perform well in the quarter due to inflation. So we'll see how that turns out. But that kind of wraps it up for today. So I will look forward to seeing you on the next video.